Hi, welcome to the valuation dashboard for the week ended the 11th of August. I've done a bit of an update this morning to capture some of the overnight movements given the falls we've seen in the US equities. Obviously it's been a very dramatic week. I'm probably not going to, rather than focus too much on the sort of, I guess, the where we've seen all these valuations end at, I'll leave that to for you to look at on the screen. I think, and sort of wonderment about how low some of these valuations are. I think I wanted to focus on some of the more interesting things that we're noting within the valuations. So it's been relatively obvious to most people looking is that government bond yields have fallen, which is the graph we're looking at there. The dark line is the current bond yield curve. The dotted line is where we saw that bond yield curve last week. So there's obviously been a big fall in that, mainly in the middle section. So we haven't actually seen much fall most recently in this long-term curve. So I guess what that's signalling is the longer-term outlook. You're getting from the bond market is deteriorated markedly over the last couple of weeks. So we saw this top section is the 60-day. The grey line is the 60-day high, but it hasn't actually deteriorated much over the last week, whereas in the last week all the deterioration's been at the short end. So I guess it's the view you sort of get from that is that the longer term outlook is still not particularly damaged, but the shorter term outlook is certainly for some rate rises within Australia. And sure enough, when we look at the cash rate implied by futures last week, we had this so that this dotted line here that is the current RBA rate. And this is what future markets are pricing in. So last week, talking about a rate cuts of about probably 2%. Two rate cuts by the middle of next year. Whereas now that's been dramatically moved down just over the last week. So now it's looking about somewhere between 5 and 6 rate cuts now priced in at the moment. What the interesting thing though is a bit more, or where I find of more interest is comparing this to the corporate bonds. So we've seen that government bond yields have all fallen dramatically, and the same thing's happened within corporate bonds, which is very different to what we saw during the credit crisis. So during the credit crisis, if we compare the triple B bond yield, so basically the bond yield of an investment grade but relatively risky stock, with the bond yield of the government, so basically what the risk of companies is compared to the government, we see, looking back over a long period of time during the Great Depression, we had this massive spike in spreads. Same during sort of World War II, and you go through all these different periods, and we saw that spike every single time we had one of these events, whether it be the end of tech boom and September 11. Russian bonds, all that type of stuff. We see these big spikes within these corporate bond spreads. What we haven't seen though this time around is that same spike in corporate spreads. So we're actually still seeing very low corporate spreads for companies at the moment, which is suggesting that I guess the bond markets certainly aren't concerned in terms of the risk of corporates. So, whereas obviously we've seen within equity markets that equity markets are. So certainly a disconnect, and you see that same disconnect within the CDS spread. So basically this is the cost to insure companies, triple B companies in Australia. You saw a huge spike within that during the 08, and although it certainly has spiked up in the last week or two, that's well below, less than half the levels that it reached during the crisis of 08.